Let's talk about some of the key differences between banks and credit unions because even though they offer some of the same services, the way they operate and who they serve can be very different. Let's start off by defining what a bank is. So a bank is a for-profit financial institution. The for-profit is the giveaway here. It's usually owned by shareholders and the bank aims to generate profits for those shareholders. Banks offer checking accounts, savings accounts, loans, credit cards, investment services, and so on. Now, on the other hand, a credit union is a not-for-profit financial institution, and it's owned by its own members. That means when you open an account at a credit union, you become a part owner. Credit unions often serve specific groups of people like employees of the company, residents of a region, or even members of an organization. Now let's talk about some of the key differences, starting off with ownership and purposes of the institutions. So banks are for profit, they are owned by shareholders, and they aim for profits for those shareholders. Now, on the other hand, credit unions are owned by its members, and it is focused on serving the community. The fees and interest rates are different too, so banks tend to charge more fees and often offer slightly lower interest rates on savings, but they often have more tech and convenience associated with them. Credit unions, on the other hand, often have lower fees and higher interest on savings, but may have limited branches or online tools available. Customer experience. Banks are structured and professional. They tend to be. Credit unions are more personal and community focused, more relaxed and chill. The eligibility, banks are open to anyone, but with credit unions, they may require specific eligibility, but many have broad criteria now. So usually with credit unions, you have to know a member or be referred to even open up an account. Now, insurance. This is where it gets pretty different. Banks are insured by FDIC, the Federal Deposit Insurance Corporation, up to $250,000 per depositor per account type. This is as of July 13th, 2025. So verify this information and stay current with it. Credit unions are insured by NCUA, which stands for National Credit Union Administration, up to the same amount, $250,000 per depositor per account type. And remember, verify this information. So no matter where you go, your money is protected. Now, let's talk about when you should choose a bank. If you travel frequently and need access to national ATMs, you want robust online and mobile banking tools, you need more complex services like business lending or investment platforms. Now, let's talk about when you should consider choosing a credit union. You prefer lower fees, you want better savings interest rates, you want more personalized customer service. You may qualify for membership in value community focused banking. So, oftentimes a lot of people check out credit unions for mortgages because they are cheaper interest rate wise, but banks often, depending on which bank you check out with, they all kind of float the same boat. So it just kind of depends on which credit union, which banker you're talking to. So there's no one size fits all answer. Banks and credit unions both play a key role in your personal finance, and your choice depends on what you value more: accessibility, technology, personalized services, or lower fees, and all in between. And remember, both are insured, both are regulated, and fully capable of keeping your money safe. So whether you're starting fresh or looking to switch, now you know what sets the two apart. Hopefully this was valuable for you.